And we're seeing big moves in the market today. The 10-year Treasury yield pushing above 4.9%. That is the first time since 2007. Investors digesting earnings reports, housing data, and Fed commentary. Amid all that, tensions, of course, rising now in the Middle East. Oil prices surging in response. There's a lot of uncertainty as investors price in the geopolitical risks. For more on the latest action, we turn to Steve Sosik, Interactive Brokers Chief Strategist. So, Steve, let me get the geopolitical risk. We were just talking to Ambassador Mark Ginsburg, about that. I'm interested to get your take about that risk, how, as a strategist, you're thinking through it. We've had some folks on the program, Steve, who are saying, listen, they think investors may be being a bit too complacent here about that risk. What do you think?
Hi, Josh. It's a tricky one because I quite honestly, my working thesis for years has been equity investors are really just not good at geopolitical risk. It's just not in their ballpark. Equity investors are very good at figuring out revenues, earnings, cash flows, et cetera, things that affect stocks' bottom line. Geopolitics are really a second or third order contingency, and it becomes very difficult, particularly on a macro basis, but certainly even on a stock by stock basis, to figure out how these kind of events affect equities. Bonds, oil, other commodities, they really understand it better because this is what they're tuned into. Those are the flows that drive them. But I think in general, stock investors have been having a little too, have been not risk averse enough, I think. And we see that in terms of some low volatility levels, whether you look at VIX or individual stocks. I think if investors were nervous and maybe a little more properly nervous, we'd see some of those measures a bit higher.
But Steve, hey, it's Julie. It's great to see you. But should they be nervous about geopolitics? When you talk about equity investors not being good historically about pricing in these types of risks, most of the time that's borne out and been fine in the end because it hasn't necessarily in many cases affected corporate profits, et cetera. I mean, there are cases on either side, right? But in this case, is it geopolitics that really equity investors need to be worried about?
Not really. I mean, you and I, Julie, have had this discussion over the years countless times, right? About like every geopolitical thing that comes up, and the market. We rightfully fret about it, and for understandably so. I mean, what's going on is tragic on so many levels. But from an equity point of view, I don't know that that's the reason to be freaking out. I do think, though, as it spills over into higher oil prices and higher bond yields. Now, remember, in theory, if you have a flight to safety trade, bond yields are supposed to go down, and they did that for a while, and now, as I think it may, as the conflict seems to be a little less on the front burner, at least in terms of the market's mind, it's actually allowing bond yields to lift. Those are the things that matter, and of course, earnings, as we're beginning really the main event of earnings season coming, starting this week and then into next week and the following week.
And Steve, another big issue, of course, is this drama in Washington. Jim Jordan comes up short again. How much do you think that mess is weighing on markets here?
Again, I think it's out there. That's the politics side of the geopolitics. I think it's funny because markets generally like some sort of checks and balances. They don't necessarily love it when one party or the other controls all the marbles. But this is sort of chaos, and I think it is spilling into international investors' viewpoints about the U.S. because I think they look at us and say, what is with these people? This was sort of a self-inflicted error that we're having a really difficult time rectifying, and it couldn't come at a worse time in terms of potential government shutdown in a matter of weeks, and again with the geopolitics, we can't embrace them as a market theory, but we certainly can't ignore them. And I think the same thing goes on with domestic politics.
How much is this sort of mispricing of risk extending to individual companies? Because one of the things you noted to us is that if you look at Tesla and Netflix options pricing ahead of their earnings reports after the bell, that they're pricing in smaller moves than we typically see during earnings. What's up with that?
I think that plays right into it. I mean, the Tesla right now, their options are calling for, call it a five-ish, slightly over 5% move this afternoon, tomorrow with earnings. Call it 5% average daily volume, but there's only 2 days left in the front expiration. Now we've gotten that 5% move today, but Tesla went down 10%, just under 10% each of its last two earnings report after its last two earnings reports. Went up just over 10% the prior one. Went up 6% the one before that, and went up 11% the one before that. So this is a stock that moves. It does, I can understand if the market is confused about direction. The direction being priced in is actually, more or less a coin flip up or down. But the idea that we're not pricing in that kind of volatility tells me that people are relatively sanguine about everything. I mean, Tesla earnings can be as unpredictable as anything because so much of the post-earnings reaction depends on the chairman's frame of mind at the press conference, which of course is impossible to model or predict. And yet we're going into what could be a very tough quarter with options just sort of saying, maybe we're not so concerned. That to me is a bit of a tell again about, people looking sort of past the risks from time to time. And I think they're looking at the potential for markets to rebound in October, which they can and often have. But I think they're a little ahead of the game because I think we have not seen a real bottom put in yet.
And Steve, also we got to talk about Fed speak. We've heard this drumbeat here, Steve, from our central bankers, our policymakers, saying, listen, maybe yields are doing the job for us. Do you believe that the Fed's rate hiking campaign is done here?
I think it largely is. I mean, realistically, if we get 25 more basis points at the end of this, kind of what's the difference? But I do think that the balance of data and the balance of rhetoric is saying if we're not done, boy, we're really close to being done. But again, this is another one of those things that I've said before: peak and pause do not mean pivot. So even if we stop hiking rates, the Fed's rhetoric has been very much geared toward keeping them high. Not so higher for longer is probably out the window, but high for longer is still part of their game plan. They're not inclined to cut rates until or unless we get sustained 2% inflation. You showed some charts before that, those numbers, depending on how you looked at them, were in the high threes, low fours. Last I checked, 4 is still above 2. And so I think they're going to remain vigilant. The rhetorical stance is going to be one of a restrictive policy until either they can really be convinced that inflation is not a problem anymore, or unless economic circumstances dictate that. And if that's the case, we really should be careful what we wish for, because it means that there would be a real drawdown in the economy, and I don't think any of us are rooting for that.